Hi everyone. So today in this session, we are going to start with one very important area from the exams point of view. The name of the chapter is Risk Analysis in Capital Budgeting. Very easy chapter, but we should understand what is the logic behind each and every concept in this particular area, especially once you understand the concept clearly and you do all the ISM problems, more than enough from the exams point of view. So how I am going to do this particular chapter risk analysis is from the exams oriented. I repeat, from the exam point of view. This video is also for the exam oriented batch only. From the exam oriented batch only, I am putting this video. Exclusively from the exams point of view. What is really required for us? What we need to understand in this chapter called as a risk analysis. Okay. I am going to focus completely from the exams point of view. Which means if a question comes in examination, in the coming examination, a question has come from the risk analysis. What questions can come, how you need to solve, how we need to answer them, okay, the procedure to tackle those questions, everything we are going to understand very clearly in detail from the exams point of view. I'm not going to tell the historic background, everything and waste your time. Okay, regular bachelor, you can understand the historic background, what is the concept, derivations, etc. From the exams point of view, out and out from exams, maximum this will be for 1 hour to 1 hour 30 minutes maximum. Okay, I will be covering this entire chapter. Okay, such that everyone going for the examinations just for max 1 hour, 1 hour 25 minutes, you spend on this video. That's all. Risk analysis in capital budgeting. Any question that comes in exam, you will be able to answer them. Clear? So the agenda I'm repeating again. Point number 1. This lecture will be covering a chapter called as a risk analysis in capital budgeting. Okay. Once you understand the logic properly, chapter is very easy. Okay. And a 5 marks question generally will come from this chapter. You can expect a 5 marks question in exam. And the areas what they will touch for this 5 marks, there are totally 6 different areas. Number 1, probability analysis. Number 2, variance analysis. Number 3, okay, certainty equivalent approach. Number 4, risk adjusted discount rate approach. Number 5, sensitivity analysis. Number 6, simulation analysis. How many are there totally? 6. In the same sequence I am going now. Okay, first one is a probability analysis. Before I go into the probability analysis and discuss about the concept, okay, you can see here on the screen. See here, there are 3 types of concepts. These 2 are one set, remaining are different sets. So there are 2 concepts here, probability and variance analysis. Variance are 2 types. Variance, variation coefficient, 2 types. We will merge both of them and solve. Because coefficient of variation is not a separate concept. It's a working note which comes after variance calculation. So nothing great. Conventional techniques, risk adjusted discount rate, also called as a radar. And the next one is certainty equivalent approach. Certainty equivalent approach. Other techniques, sensitivity and scenario analysis. Okay, sensitivity analysis and scenario analysis. Sensitivity analysis and scenario analysis we call simulation and scenario analysis. Means what? Everything we will discuss separately. Okay, first we are going to discuss first 2. Later we go to the third one. I will be spending 30 minutes on this, 30 minutes on the second one, and 30 minutes on the third one. That's all. 30 minutes, sir, everything will be completed. I am going to complete study material, all illustrations I am going to complete. Okay. In the study material, whatever the illustrations are there, every illustration we are going to do. Okay. From exams point of view. That means this lecture is not a regular batch video, exams oriented. From the exam oriented point of view, what is all required for understanding this risk analysis and capital budgeting as a chapter. Okay. First, what I will do is, I will explain you these 3 concepts, technically 2 concepts. Okay, one by one, let us go. See here. In a capital budgeting chapter, The most important technique is NPV. Okay, the most important technique is what, sir? NPV. But the problems are there while calculating this NPV. What problems? Okay, I will explain. First, let us understand this. Year, cash flow, PV at the rate of some percent, some 12%, PVCF. Life 1, 2, 3. First, what do you mean by cash flow? Generally, that cash flow which we take there will be net cash flow. Sir, what do you mean net cash flow, sir? Okay, I will write here. Sales is a cash flow minus costs is a cash flow. One is an inflow and the one is outflow. This is called as a net cash flow. Okay. So costs, in this there are 2-3 types of costs will be there. Okay. Direct costs. Okay. Direct costs, admin costs, selling costs, like that so many costs will be there. All those put together we call as a cost. In this direct cost, some depreciations and other items also will be included. All this we deduct, we will get non-cash flow. Sorry, we will get net cash flow. This net cash flow is what we always take here. If I write 70,000, 70,000 means what? 70,000 is after deducting all the costs. Okay, cash outflows after deducting. Net I am getting 70. 70,000, 80,000, 65,000 I have taken. Okay, now these are all the three cash flows. These are all the three cash flows which have already happened, which are expected to come. We are doing capital budgeting. Budget means already happened, we make budget. Yet to happen, we make budget. Yet to happen, we make budget. So it is yet to happen. These cash flows are not yet come. We are expected that these will come in future. Okay, 70, 80 and 65. PV factors you will take. So you will take some amount of PV factor. Okay. Next, you will get a PVCF. This is called as discounted cash inflow. From this, you will deduct DISCO. What is DISCO? Discounted cash outflow. The balance will be called as NPV. If it is positive, you will accept. If it is negative, you will reject. That's all. Answer over. But there is a problem in this. Till now, whatever the problems we have done till now, in normal capital budgeting chapter, we have done in the same way in which I am writing here. Then what change we are going to make? The question is, in this cash flows, whatever I have considered, sales is there or not? Okay. These sales are guaranteed estimates. These sales are guaranteed estimates. These are all estimated. Estimate of sale. Sale equal to what? Not cost plus profit, not that way. What is a sale? Sale value means number of units sold into sale price per unit. Into sale price per unit. That means every year you will estimate some number of units sold or not. Yes. Into sale price per unit. You will multiply with the sale price per unit and you will take a value of sale. My question is, you will be taking this for 1 year, 3 years, 3 years, 3 past years, 3 future years, future years. How do you exactly know that these number of units will be sold? Customers have given a bond paper agreement. Company, you do business, we will definitely buy from you. Did they give guarantee? No, they didn't give guarantee. Okay, now the point is, the number of units which is the source of bringing the sale amount is subjected to a question. Is subjected to what's a question? That means people started questioning the validity of this estimate. And they said that if number of units estimated and actual is different, delta means a change. If they are changing, you estimated some number and actually some number has happened. In such a scenario, automatically these cash flows are going to change. Though PV factor is same, this will change. Once this is changed, this decision making will change. That means there is a risk involved in this NPV. This NPV is riskier, free from risk. It is risky. Analyzing the risk in calculating the NPV became a chapter called as a risk analysis in capital budgeting. That means these cash flows, whatever you have seen now, are not guaranteed bond paper returns or cash flows. These are all estimations only. These are all what's estimations only. They may happen, may not also happen. So two sides of the coin you have to see. Okay. Sir, you are telling it is estimate. How to make it more practical? How to make it least estimation and more accurate? How can, sir, 100% accurate, no model in the world can do. Because unless and until it happens, so no one will know. Even exit poll in elections also, what they will tell. Maybe like this it can happen, they can tell. They can't tell exactly you will get 298 votes, seats in Lok Sabha. You will be getting exactly 143 votes in Lok Sabha. Like that I can't tell. I can tell generally if a person asks me, this political party will get how much? Whatever come to my mouth, I will tell, this will get in Lok Sabha, this party will get 25 MPs. I don't have any scientific estimate. Out of sentiments, I have said, this is absolutely wrong estimate. One person has conducted a survey. One news channel conducted a survey. Survey they conducted, and finally in the survey, they collected information from all the reliable sources and it has given a result. This is also an estimate only. Mine is also an estimate only, but that estimate will be given more impact and more weight because that is having some scientific backing. Likewise, just telling number of units, take 70, take 80,000, take 65,000 means may happen, may not happen. Anything can happen on that day. Therefore, the cash flows what you consider, or the DISCI what you consider, or the NPV what you consider, till now in the capital budgeting chapter is not guaranteed, is an estimate. Is an estimate. When estimations are made, they may happen, may not happen. That means there is a amount of risk involved or not. That risk will be taken out and then only we will calculate. That's called as a risk analysis in capital budgeting. That's how this chapter has started. Okay. Sir, you are telling risk is involved. We need to remove the risk. How to remove? There are three techniques. One. Type 1, again two types are there. Probability and calculations of NPV. Variance calculations on NPV. Second type. Type number 2. Type 2 concept is certainty equivalent risk adjusted discount rate. Next. Number 3. Sensitivity analysis, scenario analysis. These are the other two. First we are going to cover these two. Next these two, next these two. With that, the chapter will be complete. 6 models are applicable for exam. Any one question will come in examination out of these 6. Okay. Let us now start with the discussion of the first kind of model. What is that? Probability based model. Okay. Let's begin. So first, let us go to the study material. Okay. See here. On probability, there are 3 questions or 2 examples and 2 illustrations. 4 types of questions are there, 4 or 3. Okay, let us solve. What is a probability concept? Let us see. Assumptions. Best guess, high guess, low guess. Okay. There is a company that is going to start a project today, which is going to end in 1 year. It's a 1 year project. Okay, how many years, sir? 1 year project. Okay. In this 1 year, they will expect one cash flow or not at the end of first year. How much cash flow they are expecting? Best guess is 3 lakh. But 3 lakh is guaranteed. 30% only probable. 2 lakh is guaranteed. 60% probable. 1 lakh 20 is probable. Is guaranteed. 10% chance is there. That means what you need to understand, there is a probability not completely to get 3 lakh. No complete guarantee of 2 lakh. No complete guarantee even 1 lakh 20. 3 lakh is having 30% probability. 2 lakh is having 60% probability. 1 lakh 20 is having only 10% probability. Means all the numbers of 3 lakh, 2 lakh and 1 lakh 20,000 are probable and they are estimated. Previous problem la Either you will take this or you will take this and you will take this and calculate the cash flows and you will put the cash flows there. A previous capital budgeting problems are there. Year cash flow. Which cash flow you are writing there? Either this or this or this. All the three are having a probability. Okay, occurrence probability is there. Are you understanding or not? So therefore, try to understand clearly. In this model, we are going to reduce that risk. I am not telling you risk will come to zero. Directly taking either 3 or 2 or 1 lakh 20. Sir, 3 lakh will happen. May happen, may not happen. 2 lakh will happen. May happen, may not happen. 120 will happen. May happen, may not happen. Then what is the difference between the previous capital budgeting model and this one? Here, instead of writing any one of them, for example, I said 1 lakh 20. 1 lakh 20 in the previous capital budgeting chapter, you are taking it as 100% guaranteed. No probability assigned to that. As if it will guarantee come, you are writing. But it is not guarantee, it is only probable. Okay. So what we take is 3 lakh may not happen, may happen. What is the probability of occurrence? 30. This is as per scientific estimate, they will calculate these probabilities. How these probabilities will come, they won't ask in exam. Okay, how to do the answer we should know. In regular classes, I will tell how the probabilities came, logic behind everything. But as of now, from the exams point of view, what they will give? They will give you cash flow, they will give you probability. What we need to do? Multiply cash flow with probability. Means 3 lakh may happen, may not happen. So, the point is, in the above example, chances that cash flow will be 3 lakh, 2 lakh, 1 lakh is 30%, 60% and 10% respectively. Basic question over. Next. Same question, I just don't want percentages. I want NPV, I want the cash flow also. How to do? Just like this. 3 lakh into 30%, 90,000. 2 lakh into 60%, 1 lakh 20,000, totally 2 lakh 10,000. Next, 1 lakh 20,000 into 0.1, 12,000. 2 lakh 10,000 plus 12,000 means 2 lakh 22,000. 2 lakh 22,000 is what? Is weighted average. Weights are 0.3, 0.6 and 0.1. That means in the cash flow column, instead of taking either 3 lakh or 2 lakh or 120, take 2 lakh 22,000. That will be more probable number. Okay, that's one point. One answer over. 2 lakh 22,000. 2 lakh 22,000. Hope everyone understood the concept. Next. See this question now. Possible net cash flow. Possible chances. Net cash flows of project A and B at the end of first year and their probabilities are given below. Discount rate 10%. Both the projects initial investment is 10,000. Calculate expected NPV, not guaranteed NPV. No one can guarantee. Expected. But that expectation should have probability assigned to it. Okay. Possible event. A, B, C, D, E. Sir, what is this possible event, sir? Don't understand it as a possible event. Possible event means economic condition. Economic condition. Sir, I didn't understand. Sir, I will tell you like this. Economic condition. Overall market, bad economic conditions are there. Moderate economic conditions are there. Okay type of economic conditions are there. Okay. Good economic conditions are there. Best economic conditions are there. Market is in recession. Market is in recession. High level of inflation is going on. High inflation. Then high inflation means purchasing power will increase. Purchasing power will decrease. Means a product which is available at 50 rupees now will not be available during inflation time at the same 50. Traded somewhere at 60 or 70 rupees. People are not so much happy to buy it. Automatically when they don't buy, my sales don't happen. My cash flows will fall. Clear or not? So whenever market is bad, my cash flow will be 8,000. Okay. If the market is moderate, it will be 10,000. If the market is okay type, better than moderate, but not so good, 12,000 is my estimated sale. Okay. If the market is good, 14,000. Market is in full boom, best 16,000 I will get the sale. Listen, previous problems, I mean in the normal capital budgeting, you will take any number out of this. Any number, particularly if you take, that is wrong because every number is having some assigned probability to that. Okay. So therefore, we should not take any one particular cash flow, take a probable cash flow, which is a weighted average cash flow. Take calculators, everyone. Take calculators. This is all cash flow of how many years? 1 year. At the end of first year, by the end of first year, I may either get 8,000 or 10 or 12 or 14 or 16. Okay, these are all 1 year after, at the end of first year. Okay, so these are not years. These are all different economic situations prevailing during the year. Okay, take calculator. 8,000 into 0.1 m plus 10,000 into 0.2 m plus 12,000 into 0.4 m plus 14,000 into 0.2 m plus 16,000 into 0.1 m plus MRC. I got 12,000. How much, sir? I got how much? 12,000. Okay. Next. Likewise, project B. Economic condition is bad. High inflation is there. Their cash flows will be 24,000. Moderately 20. Okay economic conditions are 16. Good economic conditions are 12,000. Bad economic conditions, sorry, best economic condition like 8,000. Sir, when economic condition is good or best, cash flow should increase. Why reverse rate is happening? Logic is there. Banking industry runs away from or runs converse to the economy because inflation is more, interest rates will high. Interest rates hike will lead to more cash flow. So when the economic conditions are bad, banks will survive more. Am I clear? So therefore, in a bad economic situation, my cash flows will increase to 24. Okay, but 24,000 guaranteed, 0.1. 24,000 into 0.1 m plus 20,000 into 0.15 m plus 16,000 into 0.5 m plus 12,000 into 0.15 m plus 8,000 into 0.1 m plus totally 16,000. So 12,000 and 16,000 are guaranteed, probable, probable, but not like previously. Too much full amounts cannot come. Here some probability is assigned. Generally, what really happens will be somewhere 1 or 2,000 around this 12,000 only. Okay, so 12,000 is my cash inflow. My cash outflow initial is 10,000. So what is the NPV? 2,000. Next here 10,000. What is my NPV? 6,000. Okay, 6,000. So now we need to understand one very important point. See here, this 2,000 and this 6,000 is the NPVs. Yes or no? NPV you calculated. This NPV, I will tell this way. Cash inflow 12,000 I said. 12,000 will happen today na, after 1 year, after 1 year. After 1 year should have a present value or not? 10%. 12,000 divided by 1.1, 10,909 minus 10,000. If you take discounting, answer will be 909. 16,000 divided by 1.1, 14,545 minus 10,000 will become 4545. If you want through discounting, 909 and 4545, without discounting 2,000 and 6,000. Okay, Institute has done through discounting, I followed that. So 908, we got 909, 4545 we got 4544. Okay, this is how they will calculate. Understood the point or not? Okay, if you observe in this, we made investment of 10,000 today. After 1 year we are calculating all these. Sir, not after 1 year, sir. I have a 3-year project. How many projects? A 3-year project. How to do? Next question. This is a 3-year project. Okay, take calculators. Let us solve here itself. Let us solve here itself. Year 1, let us take. Year 1. Year 1, guarantee you will get 2,000. Guarantee you will get 4,000. Guarantee you will get 6,000. Guarantee you will get 8,000. Guaranteed, probable, probable. So weighted average. 2,000 into 0.1 m plus 4,000 into 0.2 m plus 6,000 into 0.3 m plus 8,000 into 0.4 m plus MRC 6,000. MRC 6,000. So year 1, 2, 3. Okay, cash flow, probable cash flow 6,000. Next, second year, 2000 into 0.2 m plus 4000 into 0.3 m plus 6000 into 0.4 m plus 8000 into 0.1 m plus MRC 4800. Next, 2000 into 0.3 m plus 4000 into 0.4 m plus 6000 into 0.2 m plus 8000 into 0.1 m plus. Totally 4200. Previous questions are 6, 4.8 to 4.2 are direct estimate. Here we calculated through scientific probabilities. Okay. PV at the rate of 10%. 0.909, 0.826, 0.751. You will get present value of future cash flows. 6000 into 0.909 m plus 4000 into 0.826 m plus 4200 into 0.751 m plus totally 12,573. And what is the investment we made? 10,000. 2573 is the answer. Exact answer we got. 2573. That's all. This is the end of another problem. I already said you I don't waste most of the time. Okay. Mainly my focus will be on explaining the concept, doing a problem and going. In that way only I can complete entire risk analysis in 1.5 hours without wasting the student's time. So understood the concept, everyone? That's all. Next concept is variance analysis. What analysis, sir? Variance. First I will explain. Okay, first I will explain. After that we will solve problems in this regard. Okay, see here. I said like this. Year 1, 2, 3, 4, 5. Cash flow 10, 15, 18, 20, 22. Random cash flows. Okay. These are all the cash flows I have given. These are all the cash flows I have given. Previous example, I mean the probability example when we have done. Probability we are taking to tell about possibility of occurrence. What is the chance of occurrence of that cash flow we have taken? But internally, what is the risk of non-occurrence we didn't see? I repeat, probability concept will discuss about probability of occurrence. Okay, we have taken some amounts of cash flows. We have assigned probabilities to them. What do you mean by that? We are assigning probability means we are estimating the possibility of occurrence or non-occurrence or possibility of occurrence. Okay, that means in that there is also non-occurrence chance or not. What is the chance that in the previous example, what is the chance that 2 lakh, where is the 2,20,000 somewhere we got? Here. This is probable 2,22 or guaranteed or probable. What is the chance that this 2,22 can't occur? That we didn't analyze. That is what we are going to analyze now. Probability distribution, what we have done, just we assigned probability to the occurrence chance. But what is the chance that your probability is taken may become wrong? Is the next question. On that, they made another analysis called as variance analysis. What analysis, sir? Variance analysis. Okay, let us understand. See here. I have taken 5 years cash flow. I have taken how many years, sir? 5 years cash flow. Okay. 5 years, there are 5 different types of estimated cash flows I have taken. Estimated cash flows I have taken. I say like this. A person came from examination hall. CA final. Okay, don't take CA inter. CA final you take. I asked him, what is the estimation of your marks on the examination you have done? Tell me a bare estimate. He said, sir, I may get 60 in FR, 65 in SFM, okay, 70 in audit, 75 in law. Like that is some pessimistically let us take. Okay, like this he said some numbers. I said, guaranteed. Sir, how can I give guarantee? I am estimating. Okay. You are estimating now. What is the chance or what is the percentage chance that your estimate may go wrong? I asked like this. I'm not asking probability of occurrence. I'm asking what is the percentage deviation that is possible from your estimate that you have made barely. Understood the point or not? So, likewise, in the same way, I am asking this question. Company is assuming that it will get, or estimating that it will get 10 crore cash flow in the first year, 15 crore in second year, 13 crore in 18 crore in third year, 20 crore in fourth year, 22 crore in fifth year. Like the person said, Marks, na? Company is also saying that it is expected to get these cash flows. Now I asked him, what is the probability that it may not occur? What is the probability that you may not get the expected marks? Okay, I am asking him deviation from your expectation. Okay, now listen. Now listen. A person is there. Okay, a person is there. He has done 5 internal exams. Internal exam 1, 2, 3, 5. 5 internal exams he has written in the institute. First internal exam in FM paper, final SFM paper. First internal he got 70. Second internal 63. Third internal he got 81. Fourth internal he got 70. Fifth internal he got 68. Say example. These are the various marks that a student got in 5 internal exams. I asked him how much he will get in sixth internal exams. How much he will get? You don't tell 81, you don't even tell 63. 81 is the highest one, 63 is the lowest one. Always we don't estimate in extremes, we will estimate always in averages. That can be simple average, that can be weighted average. If question probability is not given, it's a simple average question. These type of questions may come. But in study material or exams, these type of questions are never tested. Even if tested, you should be in a position to do the answer. That's why I'm telling this. Variance can be calculated with the 2 types of information. Probability information, no probability information. Okay, I will explain both. See here. Okay, now listen. Likewise, company is expecting, okay, company has already achieved 10, 15, 18, 20, 22. Past law, all these are happened. On the basis, they want to estimate the future. They want to estimate what's our future. Okay, now listen carefully. Past company has got these cash flows. Okay, now how much you are going to estimate or how much you are going to expect from the project in the future, I asked, because we want future cash flows. These are all past happened cash flows. 1, 2, 3, 4, 5. Last 5 years, this is a cash flow. I want to estimate a similar project company is going to start, how much that project is going to give. Tell your estimate based on the existing similar project. Then existing project 5 years back, I got 22 crores. Okay, 22 crores. Last year I got only 10. You will estimate, you will expect 10, you will expect 22, you will expect average. So total them. Take calculator. 10 plus 15 plus 18 plus 20 plus 22. How much? 85. Average means divided by 5. How much? 17. 17 is expected average, also called as a mean. Simple average mean is calculated as sigma x by n. This is x. All information given is x. Sigma x means total of x, 85, divided by n, number of informations given, 5. So you are divided, you got answer as 17. This 17 is guaranteed. This is average. Average means it is not accurate. There is a deviation. So x minus x bar. 10 minus 17 minus 7. 15 minus 17 minus 2. 18 minus 17 plus 1. 20 minus 17 plus 3. 22 minus 17 minus 5. Sorry, plus 5. Okay, this is the answer. First part of the answer is over. Okay, so these are all deviation. Deviation means what? There is a chance that this average can't occur. Okay, with using this information we calculated average, but this average itself has a deviation from this information. So more, I don't want to go into statistics. There is a chapter A for statistical measures. There we will understand. Here basics you understand. So 10 minus 17 minus 7. Okay. But listen carefully to my point. Okay. Point is x minus x bar means what is the chance that a change can happen? What is the chance that change can happen? What change? My 17 may not be true. It can move to the left side. It can move also to the right side. Means it can go up. It can also come down. 17 is not guaranteed, because if you take the first number 10, 10 is below 17. If you take last number 20, 20 is above 17. Therefore, none of the numbers are correct. 17 is also not perfect. It is only an average measure. This average is having a deviation. Okay. So deviation means a change. Change means what? It can move upwards. It can also move downwards. Means it doesn't have any symbol. To remove the symbol, we will square it. We will what's a square it? 49, 4, 1, 9, 25. Okay. 49 plus 4, 53, 54, 54 plus 9, 63, 63 plus, okay, 63 plus 25, it will be 88. Okay, x minus x bar whole square, okay, x minus x bar whole square became 88. 88. Now, 88 is for how many transactions? 5 transactions you have taken. 88 divided by 5. 17.6. Okay, so rupees 17.6. Okay, for this we should not square actually. Okay, real numbers are these, but we don't want symbol to affect our decision making. To remove the symbol we squared. Really we should not square anything, but to remove the symbol we squared. But we should not do the square. So to neutralize that, we will use square root again. So therefore, standard deviation, this is summation sigma, this is standard deviation sigma. Okay. So standard deviation of a particular project x is root of sigma, this is sigma total, x minus x bar whole square divided by n. Okay. This is x minus x bar whole square, 88, divided by n means 17.6. Total square root will be root of 17.6. 17.6 root 4.19 crores. Means what? Means 17 crore is an average. This average can go down by 4.19. Okay, 17 minus 4.19 can happen. 17 plus 4.19 can happen. That means average is 17.6, or I can tell this way. Average is 17 crore. It can go down by 4.19 crore. It can go to the upside by another 4.19 crores. Plus 4.15, minus 4.19. This is the concept of standard deviation. This is a concept of standard deviation. Sigma x minus x bar whole square divided by n is there without square root. We call it as a variance. We call it as variance. This is called deviation. This is called variance. Root is called standard deviation. Root is called as standard deviation. Am I clear? So these are all the various points. Okay. So now tell me, what is the formula for deviation? Every year we have to calculate x minus x bar is deviation. Variance, x minus x bar the whole square sigma divided by n. Standard deviation, root of sigma x minus x bar the whole square divided by n. So variance can be written as standard deviation square. Okay, standard deviation square. Because what is standard deviation? Root of sigma x minus x bar whole square divided by n whole square na square root to cancel. This will give you the variance calculation. So variance can also be understood as a square to the standard deviation. Clear everyone? These are the information. All this answer is true if the question is given as per the past trend. But majority times question will be given on probabilities. Question will be given on probabilities. Let us take a problem and try to directly solve. See here. There are two projects. Project A and Project B. Project A. If event A occur, my cash flow will be 8,000. Probability is 0.1. Simply to tell, These projects are guaranteed cash flow, probable. Okay. Cash flows are given. Here also cash flows are given. Probabilities are also assigned to that. We are to calculate the variance and standard deviation. Okay. Let us do. Let's both of us do together right now. Situation. A, B, C, D, E. Now do cash flow. 8,000, 10,000, 12,000, 14,000, 16,000. This is X. Project name is XINA. This is A. A. So tell me, this is guaranteed or probable? Probable. What is the probability assigned? 0.1, 0.2, 0.4. 0.2, 0.1. Okay. But once for all, check the total should be 1. 20 plus 10, 30, 30, 70, 90, 100. Okay, next. So this is not yearly information. You can't directly total and take it divided by n. Probability is there. So whenever probability is there, this is A, this is P, A into P, directly weighted average. 8,000 into 0.1, 10,000, 8,000 into 0.1, 10,000 into 0.2, 12,000 into 0.4, 14,000 into 0.2, 16,000 into 0.1. Total is 12,000. Total is 12,000. This is called as A bar, also called as a mean. Sir, you said mean is sigma x by n. You said this, no, sir? This is when simple average information is given without probability. Now here probabilities are given in the question. When probabilities are given, mean formula is x bar equal to sigma p into x, probability into x. So x means whatever the name given. This is p, this is x. Total of all these will become 12,000. This is called as a weighted average mean. This is called as what mean? Weighted average mean. Sir, divided by n. Here no divided by a. Here also divided by is there. Divided by sigma p. Sigma p is always equal to how much? 1. Therefore, even though if you write nothing, no value for that, anything divided by n will be, anything divided by 1 will be the same value again. So 12,000. Now tell me, what is the formula for deviation? Just now I told you, this is A bar. These are all A's. A minus A bar. A minus A bar. 8,000 minus 12,000 minus 4,000. 10,000 minus 12,000 minus 2,000. 12,000 minus 12,000, 0. 14,000 plus 2,000. 16,000 plus 4,000. Okay. Next, this is A minus A bar. A minus A bar. Okay. Now, A minus A bar, A minus A bar whole square to remove the symbol. So 4,000 square. 1 crore 60 lakh. 40 lakhs. Okay, 40 lakhs. Next, 0, 40 lakhs, 1 crore 60 lakh. 1 crore 60 lakhs plus all these put together has come to 4 crore. Okay. What is the variance formula? Listen carefully. This 4 crore you should not total. Just I total for your understanding sake. because there is no project which is giving 4 crore. Just because of scare this amount came. Okay, but don't do this. Just for understanding I told what to do. This deviation is guaranteed a probable. This deviation came because of this A bar. A bar is guaranteed a unguaranteed. This is probable. When A bar itself is probable, A minus A bar is also having a probability. So P into A minus A bar whole square. P into A minus A bar whole square. 1 crore 60 lakh into what is the probability? 0.1. 16 lakh. 40 lakhs into probability 8 lakhs. 0. 40 lakhs into 0.2 8 lakhs. 1 crore 60 lakh into 0.1 16 lakh. This we can calculate. Sigma P into A minus A bar whole square. 16 lakh into 2 M plus 32 lakh. 8 lakhs into 2 M plus 60 lakh. Totally it became how much? 48 lakh. So variance equal to root of sigma P into A minus A bar the whole square divided by sigma P. Sigma P is 1. Okay. So that equal to root of 48 lakh. Answer is 2191. 2190.89 I got, which can be calculated as 2191. Exact answer is 2190.90 I got. I rounded off to 2191. Okay. This is the answer for the first bit. Okay. Answer for the first bit. Next. Project B. Take like this situation. A, B, C, D and E. Okay. Now take this. Cash flows. Take the cash flows. 24, 20. 16, 12, 8. Let's do together fast. This is project B. Okay, project B. Probability 0.1, 10, 15, 50. Next again point. Okay, next. B into probability. Multiply. 24,000 into 0.1. 2,400. 20,000 into 0.15. 3,000. 16,000 into 0.5. 8,000. 12,000 into 0.15. 1,800. 8,000 into 0.1. 800. A B bar. B bar. 16,000. Okay, 16,000. Now, B minus B bar. Let's do together, everyone. B minus B bar. 24,000 minus 16,000. 24,000 minus 16,000. Okay, 8,000. Positive. 20,000 into minus 16,000. 4,000. Positive. 16,000 minus 6 is 0. Minus 4,000. Minus 8,000. Okay. We want B minus B bar, B minus B bar whole square, B minus B bar whole square. 6 crore 40 lakh. Okay, 6 crore 40 lakh. Next. 1 crore 60 lakh. 0. 1 crore 60 lakh. 6 crore 40 lakh. P into B minus B bar whole square. Okay. 6 crore 40 lakh into what is the probability? 0.1. 6 lakh 40,000 1 crore 60 lakh into 0.15. Okay, 1 crore 60 lakh into 0.15. 1 second, just a small adjustment. 6 crore 40 lakhs into 0.1. 64 lakhs. 64 lakhs. 1 crore 60 lakh into 0.15. 24 lakh. 0. 24 lakh. Total 1 crore 76 lakh. Okay, now variance equal to sigma p into b minus b bar whole square. Okay, so that equal to, this is the answer for variance. But standard deviation or root of variance 4195.24. Okay, so we got two answers now. We got how many answers, sir? Two answers. This is variance, this is standard deviation. Okay, let us see. 2190.9 and here 4195.24. 2190, 4195. Exact answer match. Okay, that's how you need to do. Okay, na? So this is how the standard deviation questions or variance questions has to be done. Okay, next. So what is this next model? Coefficient of variation. Coefficient of variation is not a separate model. Same as it is. Whatever we have done till now, we will do the same thing once again. Lastly, standard deviation will come now. Divided by expected cash flow means standard deviation. I will give an example. Okay, I will give an example. Project A, project B. Okay, project A, project B. Project A and project B. Cash flows. Okay, cash flows. Total cash flow I'm expecting is 1 lakh. Here I'm expecting 1,50,000. Here the standard deviation is 12,000. Here the standard deviation is 14,000. If you see the standard deviation, which is more risky? Project B is more risky, but it is wrong. Coefficient of variation says that you should take, okay, standard deviation by the cash flows. 12,000 divided by 1 lakh, 12% is the deviation. 14,000 divided by 1,50,000, 9.33% there is a deviation. This is much better because overall percentage variance is less in this project. Don't see the number, see the percentage they will tell. This is how it will be. Okay, everything is same, everything 99.9% whatever you have done now will be done once again, but with a small change. Okay, let us do also this. Don't leave any problem, but I'm telling you that nothing is there. Okay, so shall we do this? Okay, directly we will do here itself. Let's see the answers directly what they have done. First, two projects, cash flow taken, probability taken, multiplied. 10,000 into 0.1000, 12,000 into 0.2, 2,400, 14,000 into 0.4, 5,600, 16,000 into 0.2, taken at 3,200. All these they calculated. This is the A bar. This is B bar. Okay, what we need to do? A bar minus B bar. A bar minus B bar. I am doing here. A bar minus B bar. And P into A minus A bar the whole square. I will do directly here itself. See here how to do. A minus A bar. This is A bar 14,000. A minus A bar means how much? 10,000 minus 14,000 minus 4,000. 12,000 minus 14,000 minus 2,000. 14,000 minus 14,000 0. 16,000 minus 14,000 plus 2,000. 18,000 minus 14,000 plus 4,000. Probabilities, let us take properly. 0.1, 0.2. So a minus a bar whole square, 4000 square into 0.1. Okay, let us take 4000 square into 0.1 m plus. Next, directly take m plus and do. Next one, a minus a bar whole square, 2000 square into, what is the probability? 0.2 m plus, 8 lakh. Next one, 0 m plus. Next one, 2000 square into, what is the probability? 0.2 m plus. Next, 4,000 square into 0.1 m plus, MRC, 48 lakhs. How much? 48 lakhs. Okay, this is variance. This is variance. Square root is 2190.90. 2190.90. Same answer, sir. Whatever you got already. 2190.90. 419.25.23. Okay. Same answer. Whatever we have done, same answer. Previously we have done the same answer. But coefficient of variation means what extra we are going to do. Here also we have taken the same. Okay. Here also we have taken the same. But project B, the cash flows they changed here. Okay, cash flows they changed here. Instead of 26,000, actually this question 24,000. This question it is 26. It should be 24, or else answer will go wrong. Okay. For the same thing only you will get this answer. By mistake, instead of 24, they have taken 26. Same question, whatever we have done. If you want to calculate the coefficient of variation, I can do like this. Project A, project B. Project A and project B. Okay. What is the average cash flow that you got for project A? Project A, 12,000. Okay, what you got? 12,000. Here in this case we got 14,000. In this question you got 14,000. See here, 2190.90 divided by 14,000. This is the coefficient of variation. Okay. Next, here it is 0.2331. If you observe clearly, risk is less here because lesser coefficient of variation. More coefficient of variation, more risk. Okay, that's the answer. Coefficient of variation is nothing but same answer done in a different way. Same answer done in a different way. Same answer. There will be no change. Everything is same. Except that we will tell how much risky this is. Okay, in the risky projects, which is more risky, we will tell. Risk is there, which is less risk and more risk, we will tell. Higher the coefficient of variation, higher will be the risk. Okay. Next, conventional techniques. What is the next one? Conventional techniques. Let us understand what is this RADR technique first. Next one, we are going to take next area called as risk adjusted discount rate, RADR approach, continued by another concept called as certainty equivalent approach. Okay, with that this problems also will be completed. Lastly, we come to other techniques called as sensitivity analysis and scenario analysis. Okay, sensitivity analysis and scenario analysis. With that, all the main concepts of this particular chapter will be completed. Just problems we can just like that solve and complete, but the main concept that you have to understand is conceptually we are going to complete each and every concept now. Now at this stage of discussion we are going to complete risk adjusted discount rate. After that, certainty equivalent. Okay, after that, sensitivity analysis, scenario analysis. Both are to some extent similar, we will do. Okay, now see here, easy concept. Okay, just 10 minutes we have to spend on this, you will understand. First lesson, two angles of understanding risk adjusted discount rate concept. The first angle and the second angle of understanding. See here, when you take net cash flows, cash flows being outflow, okay, or cash flow being inflow, adjusted to all other cash flow being outflows in the form of depreciation, costs, etc. Everything will be cash outflow. If you observe, we will add back depreciation. We will add back depreciation. Okay. We will add back depreciation. What is the assumption? Depreciation will be added back and the depreciation will give a tax saving to us. Will give a tax saving to us. So the tax saving on depreciation is a real cash inflow. Depreciation is a cash outflow. But because of putting the depreciation on the P&L, my profits are getting reduced. Because of that lesser tax I'm paying, not paying the tax is an inflow for us. So therefore, notionally, entire financial management will consider tax saving as a cash inflow. Okay. So now listen carefully. There are two types of inflows. Inflow type 1, all other inflows like sales, etc. Inflow type 2, which will be called a depreciation, etc. Now listen carefully. Depreciation, let us say we are taking SLM depreciation. Okay, we are taking SLM depreciation. Asset value is 1 lakh. 5 years life divided by 5, 20,000 per annum. Our tax bracket is 30% rate into 30%, 6,000. Every year I will get a fixed 6,000 tax saving as an inflow. Yes or no? This is guaranteed or unguaranteed? Guaranteed. Okay, guaranteed. Next, sales. Sales, I said first year 10,000, second year 20,000. Guaranteed or unguaranteed? Unguaranteed. That means in the cash inflows, there are two types of inflows which are uncertain inflows. Second one is a certain inflows. First one is uncertain. Second one is a certain inflows. Okay. When inflow is certain, there is no risk in the project. There is no risk in the project. Okay. Now, listen, why I am telling this, you should understand. At the beginning of FM, we discussed about one concept. PV factor. What factor? PV factor is made out of two sub-factors again. Number one, risk. Number two, inflation. Number one, risk. Number two, inflation. Whenever PV factor 16%, PV factor 12%, what do you mean by that 16, 12? In the two components are there. One, risk. Second one, inflation. I will summarize. I will not explain everything once again like introduction session again. But if you have chance to forget, I will just recap the concept. That's all. I will not discuss more about it. See here. Whenever you are investing money in a project, you are not investing in a risk-free place. Sir, I didn't understand. Sir, I will give you an example. I have 1 lakh. I can deposit in SBI FD. But I am not depositing in SBI FD. I am investing in a company shares. Means by not investing in that FD, I am losing an opportunity to get a fixed return or not. Therefore, whenever you are investing in some project which is risky, the first thing is you are losing an opportunity to get a risk-free rate of interest if you invest in a FD. Yes or no? That means I want to invest in SBI, giving me 6%. Some person came and asked me, give money to me, I will also give a return. First, how much return I should ask him? First, 6 I should ask, because if I would have invested in SBI, SBI would have given me that 6%. If I give you the money, I'm losing an opportunity to invest in SBI or not. But with you, it is riskier, risk-free. It is risky. Therefore, the first thing, whenever you take PV factor, the first factor is opportunity cost, also called as risk. Okay, this is also called as a risk premium. So first we are going to ask some risk premium. Okay, next. And whenever you are putting money somewhere, by not buying something today, I want to buy an iPad today, 1 lakh rupee. If I go after 1 year to buy, inflation la price hike will be there. iPad new model will become 1,10,000. That means what you have to understand, whenever my money is blocked somewhere, okay, that blocked money should not only tackle the risk, but it should also tackle the inflation. Therefore, always remember, PV factor is made out of two things. Number one, first one will be the risk premium. Second one will be inflation. Okay, I will change this order later. First listen. Sir, what is inflation? Inflation means I want to purchase a product today. I will get that product today. I invested in SBI instead of buying this product. Means what? I am postponing buying of this product or not. Because of postponing the buying of this, in future the price of the product will increase. Okay. Therefore, where you invest, that person should not only give you the risk premium, it should also pay you the inflation. Okay. Now listen. Sir, you said normally risk free rate and risk premium, but now you are first telling risk premium. Listen, I am coming there only. Listen carefully. Inflation is nothing but risk free rate. What's that? Inflation is nothing but risk free rate. Sir, I didn't understand. I will explain. See here. You went to SBI or you went to RBI. Full risk free. RBI bonds are giving a return of 6%. They are riskier, risk free. They are risk free. But still, why they are paying return here? They are paying return not for the risk. They are paying the return for you to tackle the inflation in India. All risk-free assets are giving return because of tackling the inflation. That means risk-free rate can be called as an inflation rate or not. So therefore, whenever you are an investor investing in a company or company investing in a project, first thing is PV factors will be made of two factors. Number one, risk-free. Number two, risk premium. Okay. Inflation is also called as a risk-free. Opportunity cost is also called as a risk premium. Okay. Now listen carefully to the point. They will give question. They will give question in two ways. What they will give is first type of question. They will give some information to you. 5 years or 6 years information they will give. They will ask you, assume that all these cash flows are risk-free cash flows. Means what? SBI deposit type. Assume that and do the problem. Then PV factor should not consider opportunity cost. Only inflation you should consider or risk-free rate you need to take. They will tell the cash flows are not risk-free cash flows. They are uncertain cash flows, they will tell. Mean they are expected and are uncertain. In that case, you need to consider risk-free plus risk premium. Okay. Generally, they will give two types of projects in the question. Or one question they will give. They will ask you to do in both the models. Like this. Enterprise is investing in 100 lakhs in a project. Risk free is 7. Risk premium is also 7. Life of project is 5 years. Tell me. 1, 2, 3, 4, 5 cash flows are given. These are certain or uncertain. We should do two times. Type 1. Do the problem as if all are risk free cash flows. Also do as per risk adjusted. Means add risk to the risk free. Okay. Simply this 25 at the rate of 7% we will do, at the rate of 14% also we will do. Okay. At the rate of 7% means what? 1 divided by 1.07, 0.934, 935, 0.873, 0.816, 0.763, 0.713, 0.713. Okay. Let's multiply. 25 into 0.935, 0.873 into 60, 75 into 0.816, 80 into 0.763, 65 into 0.713, 244.34. How much is the investment? 100. So 144.34. This is the answer if these cash flows are assumed to be risk free. If it is risky, take 14. 1 divided by 1.14. 0.769, 0.675, 0.592, 0.519. 0.877 into 25. Sorry, 1 second. 25 into 0.877. Next, 60 into 0.769, 75 into 0.675, 80 into 0.592, 65 into 0.519, 199.79 minus 100, 99.79. So 99.79 in the first case or 100, second one 144.34. 144.34, 99.79. Answer over. That's all. This is one way. There is another way to give the same question. There is another way to give the same question. What is that another way? 12th illustration you come. Come to the 12th illustration. See here. This is second kind of question they will give. This is more popular, market important. Same question can also come in exam. So please be very careful. What is this question? More coefficient of variation, more the risk. More the risk, more the PV factor. Okay. See here. Net cash outflows. 2 lakh 10, 1 lakh 20, 1 lakh. Project life 5, 5, 5. Annual cash inflow 70, 42, 30. 70, 42 and 30. So annual. For 5 years you will get this. Okay. Annuity factor you need to take. Coefficient of variation 1.2, 0.8, 0.4. For various levels of coefficient of variation, they have already given the risk adjusted discount rate. Means RF plus RP already given. Okay. They have given the answer also here. Nothing great. So see here. First project 1.2. For 1.2 what is the rate? 16. For that what is the annuity? 3.274. So first project 7. I will erase. See here. First project 70,000 is the inflow. So 70,000 per annum. 70,000 into 3.274. This is inflow. Minus 2,10,000 will give the answer. 70,000 into 3.274 minus 2,10,000. 19,180 is the NPV of project X. Okay. Next. Let's do for Y. 0.8. 0.8, 14, 3.433. Every year I will get 42,000 into what is the annuity factor? 3.433 minus 1,20,000. 42,000 into 3.433 minus 1,20,000. 24,186. Next third one. 30,000 into for 0.4. Lesser the risk, lesser the discount rate. 12%. 3.605. 30,000 into 3.605 minus 1 lakh 8,150. So answers should be 19,180. 19,180, 24,186, 8,150. 19,180, 19,180. 24,186, 24,186. 8,150, 8,150. That's all. Answer over. This is how they will give the question. That's all. Nothing great. Okay. So next. Certainty equivalent approach. What is the next one, sir? Certainty equivalent approach. So let us see. Sir, what is certainty equivalent approach? Certainty equivalent approach is also similar to risk adjusted, but management decision making is involved more on the basis of the past experiences they have. Management is taking up a investment proposal here 45 lakhs. Risk-free rate 5%. Okay. Sir, where is the risky rate? Risk will not be there here. What will happen? I will explain. I went to the managing director or I went to the CFO. I went to whom, sir? CFO. I asked him, we are going to take up the new project now. What is the fate of this new project? What is going to happen? How much risk is involved in this project? I asked. He said, we are going to get expected cash flow of 10 lakh, 15 lakh, 20 lakh and 25 lakh. All are expected cash flows. They said like this. Okay. I said, you are telling these are all expected now. That means they may happen, may not happen. I want certainty of its occurrence. Okay. Management said that 10 lakhs has 90% certainty. 15 lakhs has 85% certainty. 20 lakhs has 82% certainty. 25 lakhs is having 0.78 certainty and 78% certainty. I will tell you this way. What is risk? Risk, for risk we will ask risk premium. Risk not there, we will ask only inflation risk free. Project is having a risk. Risk means what? Uncertainty. Risk means what, sir? Uncertainty. But they said it is 90% certain. 10 lakh is uncertain, but 10 lakh into 90% is a certain. So it becomes 9 lakh. 15 lakh into 0.85. 15 lakh is uncertain. 12 lakh 75,000 is a certain, because certainty multiplication already we have done. Okay, 15% is uncertain. We remove that uncertainty percentage. 20 lakhs into 0.82, 16 lakh 40,000. 25 lakhs into 0.78, 19 lakh 50,000. I will tell you this way. 10 lakh is uncertain, 9 lakh is certain. 15 lakhs is uncertain, 12 lakh 75 is certain. 20 lakhs is uncertain, 16 lakh 40,000 is certain. 25 lakhs is uncertain, 90 lakh 50,000 is certain. Yes or no? When cash flows are certain, risky or no risk? No risk. Even though there is no risk, like in RBI, we will ask which rate of PV, risk-free rate for inflation. So PV at the rate of 5%, 1 divided by 1.05, 0.952, 0.907, 0.864, 0.823. Let's multiply and sum up. 9 lakhs into 0.952, 12 lakh 75,000 into 0.907, 16 lakh 40,000 into 0.864, 19 lakh 50,000 into 0.823. MRC, it is 50 lakh 35,035 minus initial investment 45 lakhs minus 45 lakhs, 5 lakhs 35,035. 5 lakh 35,035. So 5 lakh 35,035. A small difference, 465 rupees, because of our decimals. That difference has come 400 out of lakhs. Out of 9 lakh to 12 lakh, 400 rupee difference will come because of PV factors that we have taken. Okay, remaining the answer is same. Okay, this is the certainty equivalent approach. At the end, some practical illustrations are further given by the institute. If you want, you can do those. Okay, next. One combined problem is there. Let us also do that. Let's see. Illustration 9. This is a miscellaneous illustrations. Shivam Limited is considering two mutually exclusive projects A and B. Project A costs rupees 12,000, B costs 11,000. You have been given below the net cash flow of the net cash flow probability distribution of each project. These are estimated cash flows. Okay, estimated cash flows. Probabilities are also given. Compute expected net cash flows. Let's do 15,000 directly. 15,000 into 0.4, 12,000 into 0.3, 10,000 into 0.2, 8,000 into 0.1, 10,600. Take calculator. Second, 15,000 into 0.3, 12,000 into 0.5, 10,000 into 0.1, 8,000 into 0.1, 12,300. First answer over. 10,600, 12,300. Okay, 10,600, 12,300. Okay, do it again. First one, 15,000 into 0.4, 12,000 into 0.3, 10,000 into 0.2, 8,000 into 0.1, 12,400. Sorry, I think I didn't consider one of the number. I'm very sorry. So 12,400 and 12,300. 1 point over. Calculate risk attached to this. Means he is asking calculate the standard deviation. So how to calculate? This into this. First let us do this. 15,000 into 0.4. Or you can do in one way. First, let us multiply 15,000 into 0.4. 6,000 6,000 plus 3,600 plus 2,000 plus 800. 12,400. 12,400 is what? Mean. From this mean, we need to calculate. This is A na? We have to calculate A minus A bar, P into A minus A bar whole square. Let us see. First for project A. Okay. Average is 12,400. 15,000 minus 12,400. 15,000 minus 12,400. 2,600 in the first case. Next, 12,000 minus 12,400 minus 400. 10,000 minus 12,400 minus 2,400. 8,000 minus 12,400 4,400. So directly he has also done A minus A bar. A minus A bar means 2,600. This is square multiplied by the probability. 2,600 square into 0.4. All these they have done. This is the variance. Square root of variance will be standard deviation. Okay, nothing new to do. I'm just solving fastly. Compute profitability index. What is the profitability index? Simply to understand, sigma by mean. Sigma by mean. What is the standard deviation you calculated in the first case? 2416.61 divided by mean. Already we calculated mean 12,400. 2416.61 divided by 12,400. 0.195. For project A. Project B. What is the NPV? 2147.09. Whole divided by what is the number? 12,300. 2147.09 divided by 12,300. 0.175. So which is more risky? Project A is more risky. Okay. Coefficient of variation we calculated. On the basis of coefficient of variation, this profitability index, if you want, already we have done in the original classes. Discounted cash inflow by discounted cash outflow. Risk, they asked the standard deviation. Not only standard deviation, I also calculated coefficient of variation and said which one? Coefficient of variation also I calculated. I also calculated this. In this case also, if you observe, standard deviation as a number is more in A, lesser in B. Coefficient of variation more in A, less in B. Okay. Therefore, A is more risky, B is less risky. B bit, second bit also over. Now come to profitability index. Disky by disco. What is disky? Discounted cash inflows. Discounted cash inflows. Okay. So profitability index, the total cash flows. See here. 12,400 by 12,000, 1.033. 12,300 by 11,000, 1.118. In this case, which is having more profitability index? B. B has to be selected. Okay. So project B is preferable. That's the final answer. With this, we have completed all the models in this particular area except two. What is that? Scenario analysis and what is that? Scenario analysis and another model called as a sensitivity analysis. Next model. This is called as scenario analysis. Sir, what is scenario analysis? Scenario analysis is a concept of analyzing the project on the basis of worst case, most likely case, and best case scenario. If all circumstances are favorable to you, how much NPV you will get? If all circumstances are average, how much you will get? If all circumstances are worst, how much you will get? On that basis, we will do the answer. Okay. Dead DZ concept, see here. XYZ is considering a project A. Outlay 14 lakh. Possible 3 cash inflow attached. Year 1, year 2, year 3. Worst case, you have to see horizontally. Okay. Okay. Let us see the answer now. First, let us do worst case. I will be getting 450, 400 and 700. Assuming cost of capital is 9%, determine NPV in each scenario. First, if you take worst case scenario, which one? Worst case scenario. See here. 1, 2, 3. Cash flow. 450, 400, 700. Okay. PV at the rate of 9%. PV at the rate of how much percent, sir? 9%. Okay. PV at the rate of 9%, if you take, directly let us do 1 divided by 1.09. 0.917, 0.842, 0.772. Okay. 450 into 0.917, 412.65. Next, 400 into, just a minute, 412.65. Next, 400 into 0.842, 336.8. 700 into 0.772, 540.40. So the final answer is 1289.85. Okay. Minus, what is the outlay? 14 lakhs. In thousands, now 1400. So minus 1400. Minus 14. This is the inflow. Worst case, now this is the inflow, that is the outflow. You will be getting a negative NPV of 110.15. Negative. 110.15. Negative. Second, most likely 550 into 0.1917, 450 into 0.842, 800 into 0.772, 1500.85. 1500.85 minus 1400. Okay. Answer is 100.85. Answer is 100.85. Answer is 100.85. 100.85. Next, third scenario. Do 650 into 0.917, 500 into 0.842, 900 into 694.8 plus 421 plus 596.05. 1711.85 minus 1400. 311.85. Positive and positive. That's all. Okay. First bit over. Determine NPV of each scenario calculated. If XYZ is certain about most likely result in first 2 years. So first 2 years it is expecting. First 2 years it is expecting these two. Okay. And uncertain about the third year. Uncertain about third year's cash flow. What will be the NPV expecting worst case scenario in third year? Third year they are expecting worst case. Means they are going to expect 540.4. So what are the probable cash flows they are expecting? 504.35 in year 1, 378.90 in year 2, 540.40 in year 3. 504.35 plus 378.9 plus 540.4 in third case. 1423.65 minus 1400, 23.65. Okay, 23.65. Same thing. So instead of taking, they are taken numbers like this now. 23.65 means into 1000 if you make, we got 23,650. Why this difference is coming? Because they have directly taken these here. Okay. They have directly taken. We have taken three digits now. That's why that 100 or 200 rupee difference will come. But this is the answer. Okay. Simply to tell you, check the numbers. What we have done. 504.35, 504.58, 378, 378, 540, 540. That last digits the change is there now. That's why that 100 or 200 difference is coming. Remaining everything is same. With this, we have completed scenario analysis also. Okay. Next, last one. Sensitivity analysis. Similar. Here what we will do is, we will take some factors of capital budgeting into consideration. How our NPV is changed if any or all of the factors are changing. Different factors we will consider. See here. X Limited is considering its new project. Initial capital cost 400 crore. Unit sales. Okay, annual unit sale 5 crore units. Selling price per unit 100. Variable cost 50. Fixed cost 50 crore. Discount rate 6. Calculate NPV of the project. Can we calculate NPV of the project directly? Yeah. Yes. How? NPV is nothing but calculation of outflow and calculation of discounted inflow. Annual sales, 5 crore into what is the selling price? 100. Total 500 crore. Okay. Sales minus variable cost 50. 5 into 50. 250 crore. Variable cost. Contribution 250 crore. Minus fixed cost. Minus fixed cost. Okay. Depreciation not separately given. Nothing to take. Fixed cost 50 crore. What is EBIT? 200 crore. Okay. 200 crore. They didn't give any kind of taxation, etc. So therefore don't take anything. 200 crore is the EBIT. This is cash flow. This is cash flow. Next, what is the life? What is the life of the project? So calculate the NPV of the project. See here. Initial capital cost to unit annual unit sale. Selling price, fixed cost per year, discounting rate. This is what they have given. Okay. If this is total cash inflow. So what is the total cash? What is this outflow? Whatever they kept, 400 crore outflow they kept. Okay. Next, project life. Here they have given project life as how many years here? 3 years. How many years? 3 years. So year 1, 2, 3. 200 crore we have to take. So 200 crore. We discounted. NPV is 134.6. Up to here everyone can do. Next bit important. Okay. See the screen. Compute the impact of project's NPV considering 2.5% adverse variance, means reduction in each variable. What are the variables here? Sales is a variable. Selling price is a variable. Variable cost is variable. These three are variable. 3 different scenarios we need to analyze. What are the 3 different scenarios? First scenario. What if annual sales are reduced by 2.5%? Okay. What if annual sales reduced by 2.5%? Okay. And what is the answer change if the selling price reduced by 2.5? What is the answer if the variable cost reduced by 2.5%? Okay. That we need to do. See here. Dead easy here. Very easy. No worry. See here. Base. What we have taken now? 100. Variable cost to contribution. Okay. Now see here. See here. Initial capital cost. Okay. Initial capital cost. See here. I will explain you how to do and what institute has done. Adverse variance means what? Negatively it should impact. Okay, negatively it should impact. What do you mean negative impact? Unit sales 5 crore I expected. 5 crore adversely means minus 2.5%, 4.875 crore units only sold. How the entire scenario will change? We will do one time. Next, selling price. we want to sell at 100. Adversely means you should not add to that. We should reduce 100 minus 2.5%. Sale price fall to 97.5. 5 crore we will take. First scenario, sales only reduce it to 4.875. Full answer. Remaining is 150 crore, 6%. Same. We will do one. Later, 5 crore will be there. Instead of 100, we will take 97.5 and we will do. Variable cost. Cost is 50. Adversely affected means cost should not be reduced. It should add by 2.5%. 50 plus 2.5. 51.25. Remaining all things are constant. This will change. But the only worry point is fixed cost can't be a variable. But institute has done answer also for fixed cost. Let's go by the institute. Actually, fixed cost is a cost which is not a variable. He clearly said that each variable, fixed cost is not a variable here. But still they have done the answer for fixed cost also. God should know why. Sir, anyway, we have to go as per the institute. We can't say no for that. So 50 crore, if it is raised by 2.4, how it will be happening, that also we need to show. That's all. Remaining everything is same. Okay. That's what they have done here. See here. See here. Initial capital. Capital is there. Sorry, I forgot to tell. Capital 400. Okay. That increased to 410. First adverse means more investment we need to put. 410. Initial capital increased to 410. Remaining are same. Selling price is 100. Variable cost contribution. Number of units sold to total contribution, fixed cost. Net cash inflow 200. Okay. So you are going to get 200 every year. Okay. 200 every year. 200 into 2.673. 534.6. Initial cost is 410. So you got 124.6. In normal scenario, base case, you got 134.6. In adjusted case, you got 124. 124 is the answer when if the sales, if the capital cost, if the investment is increased to 410. Okay. Next. Investment is 400 only. Selling price per unit fall to 97.5. How it will impact? Let us see. Sale price per unit 97.5. Variable cost 50. Contribution 47.5. Okay, that will be called as contribution per unit. Contribution per unit. Number of units 5 crore. Total contribution 47.5 into 5. 237.5. Fixed cost minus that is same 550. 187. So 187.5 into 2.763. 501.19. Okay, 400 is the capital cost. You got 101.19. From 134 to 109. How much change? How much change? 101.19, 101.19 minus 134.6 divided by 134.6 into 100 minus 24.82. Okay, next. Easy and nothing is there. Next, first over, second also over. Let's take the third one. Variable cost per unit. Everything is same. Variable cost is changed. Sales is 100. Variable cost is this much. Contribution is 48.75. Okay. 48.75 into how many units? 5 crore. 243.75. Minus 50 crore fixed cost. 193.75 into 2.763. 517.89. Minus 400. 117. Change is 12.41. Next. Everything is same. Fixed costs are increased to 51.25. Up to here everything is same. Okay, like this one, like first one, last one same. But here reduction is there. 198.75. You got 131.26. Change is only 2.48. Next. If the units sold, reduce it to 4.875. 50, these are same. But here there will be a change. I got 243. 50 reduction, 193.75. I got 12.41. Here in all these cases, which change in factor, which factor change led to more change in NPV? Selling price per unit. That means company has to take care that price should not fall. This is called as a sensitivity analysis. Sensitivity means different situations we will alter and we will do the answer. That's all. With this, the entire concept of risk analysis in capital budgeting is completed. Similar problems only will come in examination. Okay. This is what I want to convey. I promise you I will complete in 1 hour 30 minutes, 10 minutes extra, 1 hour 40 minutes we have completed this entire concept called as a risk analysis in capital budgeting. 6 concepts we have done. First one, probability, variance, standard deviation, coefficient of variance. Next one, certainty equivalent, risk adjusted discount rate, scenario analysis, sensitivity analysis. Hope everyone is having a full clarity on the concept, right? Thank you very much. If you have any doubts, put in the comments.